Well, hello and welcome back to the Clara CFO Group channel. Today we're going to continue the series that we've been doing about improving the cash flow in your service-based business. And today we're specifically going to talk about a financial metric called the cash conversion cycle. Now, this is something maybe you've never heard of before as a small business, but I wanted to talk to you about it today because it can be very important in helping you overcome some of your financial challenges, specifically around cash flow. So if that sounds good and you want to learn how to improve your cash flow, then make sure you stay tuned to the channel. And also, if you aren't already subscribed, I'd love to have you here as a subscriber to the Clara CFO Group channel, at least the new Clara CFO Group channel. So click the little subscribe button if you can, and it's not already clicked, go ahead and do that, and also put on the little notification bell as well so that you'll be notified whenever we have new videos. Okay, so cash conversion cycle, what is it? So it is a financial metric, again, that basically tells you when you look at a business how fast it turns its resources into cash. So for a product business, that would be its inventory. How fast can it get the inventory in, and then how fast can it sell it? That's like the cash conversion. But for service business, which most of you who are watching this are, it's really about the resources, the time, the labor that gets put into the system. How long does it take that labor to turn into cash? So there's lots of different factors that go into that. Now I will show you, I'm going to take you through a couple slides that we have from a presentation that I've done about cash flow. And I think this is going to be a nice visual to just help you think about how to improve your overall cash conversion, because the faster you can convert your resources into cash, the better off you're going to be, and the faster cash conversion you're going to have, which is going to increase the overall cash flow in your business. Okay, so cash flow conversion cycle. Let's go ahead and I'm going to share my screen. Okay, so here we are with a graphic that I really like. Now this comes, I want to make sure that I give credit where credit's due. This comes from the Scaling Up book that is written by Vern Harnish. And this is just a nice visual here about cash conversion cycle. So the overall, this top line is everything that we're going to talk about is the cash conversion cycle. And that includes the sales process, the delivery cycle, and then the billing and payment. In a service-based business, for example, that could be, from when you are selling for your services to when you're finally receiving payment for those services. Okay, so that can be a really long time. What we're going to talk about specifically is more this delivery cycle to the billing cycle in this video, because the sales cycle, I am not a salesperson. I am not a sales professional. I am not the right person to tell you how to speed up your sales cycle, but you might understand like, hey, if I have a really great cash conversion between delivery and billing, and I'm still having some cash flow problems, then maybe that means that you need to think about the sales side, and this will help you troubleshoot some issues. Okay. Down here, this is like if you had inventory. But since this channel, we talk mostly to service-based small businesses, we're not going to get into inventory today. Okay. So what we're going to talk about is from delivering the service to actually billing it. What can we do to increase that conversion rate? Okay. Or that conversion cycle. Okay. A cash conversion cycle for a service-based business has two main components. That's going to be the days sales outstanding and the days payable outstanding. So it's going to be cash conversion cycle equals days sales outstanding minus days payable outstanding. Okay. So days sales outstanding, we actually already did a video on this, so you can go back and watch that. We'll make sure to link it above here. Days sales outstanding, that is how long it takes you to collect the payment after delivering a service. So that gives you a sense of like how many days typically are your invoices outstanding. And then days payable outstanding is how long the business takes to pay its expenses, such as like your rent, your contractors, software expenses, etc. Okay, so this is just how we calculate this, okay? And this is going to be a financial metric that you can continue to measure over and over and over again, so you can see if you're getting a little bit better, a little bit better, a little bit better. The idea here is that you want to have a lower CCC. So the shorter your cash conversion cycle is, that means faster cash flow, better liquidity. The longer is going to be slower cash flow and more of a potential for a cash crunch. So for example, if your day sales outstanding was, let's say 60 days, it took you on average 60 days to collect on your receivables, and then you paid your payables pretty fast, like you paid your bills as soon as you get those bills into they come in and you pay them right away, let's say that's like 10 days, then it'd be 60 minus 10 equals 50, and your cash conversion cycle would be 50. And the other way, you could say, what if your day sales outstanding was 30 and you had net 30 terms, and then you used your net 30 terms for all of your vendors, your days payable outstanding, and that was also 30, then your cash conversion cycle is basically 0. So that would be a really great metric here. So if your cash conversion cycle, like I was just saying, was if the day sales outstanding was 30 and then the days payable outstanding was 30, then you would have a CCC of 0, and that would be really good. And it's okay to go into the negative. So let's say that you actually have a day sales outstanding of 0 because you actually invoice at the beginning of the month and you actually never have, and you have your clients on retainer where their credit card is being charged at the beginning of the month, even before you do the work, then that would be 0. And then your days payable, you're taking advantage of terms, that's minus 30, let's say it's net 30, and you take advantage of those terms, then you would actually be negative in your cash conversion cycle metric, and that would actually be a very good thing. So the sooner you can collect payment, that's going to lower your day sales outstanding, and then the longer you can kind of stretch out your payables, that's also going to lower your sales outstanding. So, all right, so here's some ways for you to think about accelerating cash into the business and helping shorten your CCC. All right, so the first one I want to mention is a fixed fee arrangement where you can move your billing to day 1 of the billing cycle rather than day 30. Now, if you're on day 30 right now of the billing cycle, so let's say your monthly service, let's say you provide landscaping services, for example, and every single month you provide landscaping services and you know what that fixed arrangement is going to be for your clients every month. If that's the case, and typically you don't bill them until it's already done, you could potentially think about, how can I move my billing to the 15th of the month, or maybe even the 1st of the month, to get prepaid for the month ahead. That is very much a potential for most service-based businesses, and it's something that you could think about when you have an ongoing relationship with a client. So can you move that billing cycle a little bit earlier? Another thing that you can look at is contractual changes in your business. So you might want to look at your contract, and because you might say, hey, our contract says we have to bill after the month is closed, and then we have 10 days to get the invoice in, and then we don't get paid for 30 days after that. So you have a really long billing cycle for when you're billing your clients. If that's the case, you want to try to figure out how you can change that by looking at your contract terms. So can you change it to a net 15? Can you bill the same day after the month closes? Can you potentially have something like a monthly flat fee rather than doing an hourly arrangement where you can bill upfront and earlier in the month? All of those things are things that might take a little bit of time to implement, but they could be very well worth looking at your contracts and saying, like, how can we shave some days? Because days can actually add up to be really big changes over time. So, can we shave 5 days off of our cash conversion cycle? Can we shave another 10 days off? And all of that is going to help your cash flow. Another thing that you can do to help is make sure that you charge and enforce late fees. So I've seen this all the time where businesses are like, yes, I know I have outstanding receivables, but I'm not going to go chase after them. They've been a client for a long time. I know they'll pay. They're good for it, blah, blah, blah. We've all said it before, right? Well, here's the thing, that if a client knows that they're not going to be enforced to pay you, and what if they're thinking about their cash conversion cycle and they're thinking, well, I don't get an interest charge from that vendor, so I'm going to push out that payable as long as possible, because if they are paying you, you are payable to them. So they might be trying to push you out as long as possible. But if you start enforcing late fees, then it's going to be that reminder of like, hey, this vendor is not playing around. You need to collect on your receivables and you're going to be more prioritized to be paid. Okay. Now, I love the idea of like, hey, the first time it happens, you enforce the late fee. Somebody calls you up and says, oh my gosh, no, I'm paying right now. I promise, we're sending you with a check. You could potentially, decide if you want to say, hey, this first time is waived, but after that, so we do enforce a late fee. Now, something like QuickBooks Online now has automatic late fees that you can add to your invoices. So, you can look into that and that could be helpful. Another thing you can do to help shorten your cash conversion conversion cycle is to take deposits on services. So that would be like prepayment for services upfront, not refundable deposits. Those are treated differently from an accounting perspective, but you want to say like deposit on services that is non-refundable. That is a good way to bring in money earlier and will help improve cash flow. Another way to shorten this cycle is to prioritize your billing and make sure that it is a very important task, okay? So don't get into the trap of potentially, if you bill your clients after the month closes, don't wait 5, 6, 7 days to start the invoicing process, day 10, day 15, before you're even sending your invoices out to your clients. Clients don't like it if you send it on the 15th, but you date it for the first of the month and then give them net 30 days to pay when they haven't received the bill for 15 days. So typically your net 30 terms start at the time that you send the invoice. So if you're not sending it until the 15th of the month, then they have another 30 days to pay it. Now you are 45 days after those services were rendered, 45 plus days after those services were rendered, that you are not receiving your cash. So make sure that you're prioritizing your billing, because you're billing and you're getting that done after the month end as fast as possible if you're an hourly biller type business. Another one, make it easy for your clients to pay. Do not put them through a whole thing where they have to send you a check, or they have to send you a wire transfer, or they have to do this, or they have to do that. Like, give them options on how to pay you and make it easy for them. So all of the modern accounting solutions now have abilities to send invoices and to accept credit cards, or to be able to get ACH payments through systems. So think about how you can receive your money easier and make sure that it's easy for your client. Now, if you're transferring hundreds of thousands of dollars, maybe wire transfers are the only way that you can go, but make it easy for them. Do they have the wire transfer information on the invoice so they're not having to contact you separately? Can you get it set up for them so that it's easier and that they, know exactly what to do when they go into the bank and they need to transfer you money? Think about how easy it is for your clients to pay and give them options. I am always a fan of giving somebody the option to pay with credit card, even if it means I have a bigger fee on that credit card, because it typically means that they will pay faster. And then I just factor in the fact that, yes, I'm going to be accepting credit cards into the overall pricing of my service. Okay. Wherever possible, think about automation and charge your clients automatically. So if you're on recurring services, which a lot of us are building recurring service businesses, you can get recurring billing up and running. So where you are not even having to run credit cards every single month, the system is running them for you. And so there's lots of great solutions for that. And that's definitely going to help your cash conversion cycle. And then another thing that you can do is you can incentivize your customers to pay quicker. So one way that you can do this is you can offer a discount if they pay within a certain number of days. The common term for this would be like 2% if paid within 10 days. The total amount is due in 30 days. That's called 210 net 30. So those are really standard terms that give kind of a preference and if you want to pay in a more accelerated manner. So if you're like, hey, I want to shorten my cash conversion cycle, I'm going to start offering my customers 210 net 30, a lot of organizations are going to be required to take those terms if they are given. So especially larger organizations, they will have finance teams that kind of say like, hey, if you get preferential terms, we want to take advantage of that, because for them, cash is not so much the issue. It's getting their cost of service down as much as possible. So if you are working with larger organizations, definitely try that one out and see if it helps your cash conversion cycle. Okay, all of those ways are going to be ways to accelerate cash into the business, mostly in this billing and payment cycle part of the total cash conversion cycle. So, you can think about like, how can I speed up delivery a little bit more so that I can, deliver the service faster and then I can bill. Or, we bypass that part altogether and we just bill at the beginning of the service cycle, like the actual delivery piece. So this part right here, this point, can you bill here instead of here at the end of the delivery cycle? That is one way that you can really accelerate and get a really nice cash conversion cycle for your business. So at Clara CFO, we provide CFO services for small businesses. And one thing that we do is that we bill at the beginning of the month for the services that we're going to render during the month. So we bill on the first and then we deliver throughout that month. And then we bill on the first for the next month and then we deliver services through that month. So that gives us a really nice cash conversion conversion cycle, and it helps us have a more steady cash flow than we would have if we were like billing hours and tracking hours. And it helps our clients know exactly what to expect as well. So if you are interested in CFO services, or you want somebody to help you with a cash conversion cycle and how to reduce the number of days that are in your cycle, we would be happy to help you out. So if you want to reach out to us, you can go to claracfo.com, and I will also put the link in the description box below. But I hope this has been really helpful for you. If you have any other questions about the cash conversion cycle, please put them in the comment section below. Or if you just have cash flow questions in general, or just questions about Clara CFO, feel free to reach out to us directly. I will see you guys in the next video. All right, bye.